Hi everyone, I'm Chris Tipper, Chief Economist and Strategist for the Ainslie Group, and welcome to Ainslie Insights for another week, starting with our precious metals update. What a week it's been in the world of precious metals. We've got central banks stockpiling gold, silver riding high on economic signals, and platinum surging thanks to supply woes and car makers. Whether you're a long-time investor or just curious about what's happening, we're here to break it all down for you. This presentation is brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Be sure to have a look. Let's get started with gold. Gold is currently valued at 5,090 Aussie dollars per ounce. Gold continues to serve as a key asset during periods of global uncertainty, maintaining its prominence in recent market activity. Central banks have increased their gold holdings, with purchases totalling 20.5 tonnes, according to the latest data from May. Kazakhstan led with 7.5 tonnes, followed by Turkey, Poland and China. In the first quarter of this year, central banks acquired 244 metric tonnes, a 24% rise above the 5-year average. This reflects gold's role as a safeguard against currency fluctuations and economic risks, particularly in the US dollar's share of global reserves, which have fallen to about 43%. Ongoing geopolitical issues, such as Middle Eastern conflicts and trade tensions, have reinforced gold's status as a preferred asset. Coupled with concerns about inflation and debt levels, these factors have contributed to upward price trends. Investor activity differs across regions. In the United States, retail investors have reduced their gold positions, whereas demand in Asia, notably China and India, purchasing remains robust. Physical gold purchases in China have risen sharply, and Southeast Asia reports a 30% increase in bar and coin demand. This contrast underscores gold's versatility as both a speculative investment and a reliable store of value. The London Bullion Market Association recently clarified that gold will not be classified as a high-quality liquid asset under Basel III regulations. Nonetheless, its designation as a Tier 1 capital asset since 1988 reaffirms its established financial standing. HSBC predicted a 2025 gold price of $3,215 per ounce, just under 5,000 Aussie, yet current prices have exceeded this forecast, reaching $3,338 per ounce or 5,136 Aussie due to the US trade uncertainties and a declining dollar. While some analysts anticipate a potential slowdown if supply rises or physical demand weakens, global uncertainties are expected to sustain gold's value over time. Gold remains a dependable asset, underpinned by central bank acquisitions, geopolitical developments, and its protective role in uncertain economic conditions. Next, we address silver, currently priced at $56.37 Aussie cents per ounce. Silver has displayed considerable price movement this week, influenced by economic reports and its dual function as a financial and industrial asset. The June 2025 US employment report revealed a surprising drop, with 33,000 private sector job losses against an expected gain of 95,000. This weaker than anticipated data has raised the probability of a Federal Reserve rate cut in September, a scenario that typically benefits assets like silver. A declining US dollar, with the dollar index dipping below 100, has made silver more accessible to global investors, enhancing demand. Additionally, central banks in emerging markets have started to bolster their silver reserves, signalling confidence in its value amid economic shifts. Silver hit a 2-week peak of $36.80 per ounce or $56.62 Aussie prior to the US jobs data release. From a technical perspective, silver has moved beyond a descending triangle pattern, indicating potential for further increases if economic conditions align. Silver's significant use in industries such as electronics, solar energy, and medical technology supports its demand. Accounting for over half of its consumption, these applications position silver to capitalize on technological progress and the shift towards sustainable energy solutions. Silver's prospects appear favorable, driven by economic trends, a softer dollar, and strong industrial demand. At $56.37 Aussie, it presents Australian investors with an asset offering both stability and potential growth. Finally, we consider platinum, currently trading at 2,114 Aussie dollars per ounce. Platinum has performed strongly so far in 2025, achieving a 40% price rise in the first half of the year, including a 28% gain in June, its best monthly result since 1986. Platinum's price surge is primarily due to supply limitations, especially in South Africa, which supplies over 70% of global production. Output has decreased from 5.3 million ounces in 2006 to about 3.9 million ounces today, impacted by power shortages, regulatory hurdles, and logistical issues. The World Platinum Investment Council projects a 2025 deficit of 848,000 ounces, emphasising market constraints. The automotive industry, representing roughly 50% of platinum demand, is a key driver. After falling to 3.1 million ounces in 2024, demand is expected to recover to 3.245 million ounces in 2025, fueled by rising hybrid vehicle sales, particularly in China. The shift from palladium to platinum in catalytic converters, due to cost advantages, is also gaining momentum. Other demand areas face difficulties. Jewellery, which accounts for 25% of consumption, has remained flat, especially in China, while industrial uses, like glass production, have declined. Nevertheless, emerging uses in green technologies, such as fuel cells and hydrogen systems, suggest further growth opportunities. Platinum encounters resistance at $1,430 per ounce, or roughly 2,200 Aussie. Breaking this level could pave the way for additional gains, with targets possibly reaching $1,500 after a recent retreat to 1,360 per ounce, or just under 2,100 Aussie. The overall trajectory remains upward. Platinum's outlook is positive yet measured, supported by supply shortages and consistent automotive demand, despite challenges in other sectors. In conclusion, central bank gold purchases, geopolitical tensions, and economic indicators like US employment data are driving investor interest. Asian demand for gold remains strong, contrasting with speculative selling in Western markets. Silver benefits from its financial and industrial roles, fueled by technological advancements. Platinum, despite supply challenges, is buoyed by automotive demand and green technology prospects. These metals offer stability and growth for diversified portfolios, especially for Australian investors with the Aussie dollar sitting around 65 cents. What do you think? How will the increased purchasing from central banks affect the commodities market in the third quarter of this year? Until next week, good luck in the markets and be sure to visit ainslie.com.au for the latest news and updates.